Well, good morning or good afternoon to everyone, depending on what part of the country you're calling in from. My name is Ginger Bell, and I'd like to welcome you to the Finance of America Wholesale Mortgage 2 Flex X Bank Statement Programs. So let's get started. What is 2X Flex? So 2X Flex allows your self-employed borrowers to qualify off of their deposits rather than their bottom line on taxes. And we know there's a lot of self-employed borrowers out there, and this is an exciting program because for a long time, we have been needing a program like this for our self-employed borrowers. So self-employed borrowers are defined as borrowers who own more than 25% of the business. And you can qualify using 12 or 24 months of personal or business bank statement. So that's very exciting because the personal side of the bank statements is a big one. So how can you help and use 2X to help your borrowers? And we're going to get into a lot more details on these, but the first thing that's important to know is there's no tax return requirement. You can also qualify with co-borrower's income, and your self-employed borrowers can own multiple businesses. And we know a lot of self-employed borrowers do. And, when we look at our economy today and the opportunities that exist on the internet, there are several individuals who have multiple businesses because you can do that now on the internet. Maybe they sell something on Amazon, or maybe they have an online store, or maybe they're like my son, he owns esports teams. So there's lots of different opportunities for people to own multiple businesses now. And so with this program, they can do that. So the 2X Flex could be the solution if borrowers don't show enough income to qualify after write-offs, but still show that they make enough money to pay their mortgage. So now you can use the deposits for them to qualify for the mortgage. So you may also have a borrower that's a 2-income household. And so the 2X Flex allows the self-employed borrower to qualify using bank statements combined with wages of a salaried co-borrower. And so again, there's a lot of individuals out there that have that scenario where somebody holds a job, maybe they do that in order to keep their benefits, but then the other borrower is self-employed. So the next thing is if the borrower has up to 3 businesses, you can use the income for all 3 of those businesses. So this is BAM's first product with credit classes. And so under the 2X Flex, we have 3 options for credit classes. The first is the Elite class, which is for well-qualified borrowers. The second is the VIP class, which is for good credit borrowers, but maybe they have some delinquencies. And then the third is the Insider class, which is for borrowers who have okay credit with perhaps a recent credit event. And so it's important to remember these various credit classes when you're looking at the product parameters. And I'm not going to go through each of these, but this is FAM's first product that offers jumbo loan amounts with FICO scores as low as 600. So again, very exciting there. And as you can see in going through the diagram, each credit class has slightly different offerings. And so you'll see the differences in the product matrix and throughout the guidelines, especially the credit guidelines. All credit class differences will be color-coded as you see in this example. So Elite in what's called electric color, VIP is in a jade color, and Inside is in tangerine, which is very helpful. So this is to help you distinguish the color guidelines for your borrower. So it's important to remember that as you're going through the guidelines. So let's talk about some income documentation. And I'm seeing lots of questions come in already, so that's great. Hopefully this will address some of those questions that we're seeing. And let's talk about the bank statement documentation requirements. So the type of income calculation chosen will determine the required documentation, but you always need 12 or 24 months of bank statements. And the documentation must show ownership percentage. So it can be in a CPA letter, it can be an operations statement, something equivalent. And you also need a verbal verification of employment. You also will have required, based on the calculation method, profit and loss, borrower or a third party, and you'll need a third party expense summary. So under your bank statement requirements, the bank statements must be the most recent consecutive 12 or 24 months. And so if you need to look at that as far as the over and under of your 45 days prior to the application date, and if it's greater than 60 days of the funding date. So that's requirement there. The bank statements must include the following: the account holder's name and address, the beginning and ending average balance, the institution name, the account number. Truncated account numbers are permitted, and you need to have the statement period. So all of the things that are listed here are required to be shown on the bank statements. Ineligible documentation includes a verification of deposit, a VOD, transaction history, or a third-party verification. So you need to have the statements and then need to meet those requirements. So let's determine what bank statements will be used on each calculation method. And we'll start with personal bank statements. So remember, we can use personal bank statements. So even if they have bank statements and it doesn't have their business name on there, they can still use those statements. And say the borrower tells you they want to use their personal bank statements to qualify. So in order to determine how you will calculate the income from the personal bank statements, you will first need to find out if they have a business account, bank account. So if they don't have a business bank account, they only have personal, then you can use that. If they only have the personal, they can use the deposits from their personal account, but they must use one of 3 business bank statement calculation methods. And so it's important to remember that. If the borrower can only show 3 months of business bank statements, then you can continue on with the personal bank statement calculation method. So you can actually combine the 2 of them, which is a good thing to be able to do that. So if the borrower has a personal and a business account, you're going to continue with the calculation, but you're going to base it on the personal bank statement method. And we're going to get into discussions on the actual calculations on determining the calculations of the bank statements, both business and personal, in upcoming webinars. We didn't want to go through too much on this because we want to give you an overview first. So make sure and look for webinars that are coming up, and then we'll go through some of those calculations there. So let's talk about business bank statements. So you can use one of 3 calculation methods, and you can calculate income from one of 3 business bank statements, and that's one calculation method. That is the fixed income expense ratio, the third-party expense ratio, or the borrower-prepared P&L. So you're going to calculate the income from one of 3 bank statement calculation methods, and this is for your business bank statements. And as I said, we're not going to go through the details on what's, the requirement and how to do that on each of ones, but we will be going through both the personal and the business bank statement calculations in upcoming webinars. So make sure and look for that. So under business bank statements, remember, up to 3 businesses are permitted. When they own multiple businesses, business bank statements are required, and they must use the same calculation method for each business. So whichever calculation method they determine to use, they're going to use that calculation method for all 3 businesses. And again, I don't want you to get caught on this as far as having to know what it is. Your Finance of America account executive is trained on these. It is a new product. We have lots of resources available on this to help you through it. It's just important to remember to first ask what kind of bank statements they have, personal or business, and how many businesses that they own. And then from there, then you can get into the other requirements and start using the calculation. Multiple business, for multiple businesses, multiple bank accounts for the same business and multiple businesses using a personal bank statement may be considered on a case by case. That is on a case by case. So I don't want you to hear that and say, okay, we can do that. If you have a scenario that's a little wonky and a little bit different, contact your Finance of America and account executive, go through the scenario with them, and then they can determine what's going to be the best method for you to go through with that. So let's say the borrower has both personal and business bank statements. And so for the calculation, and this is a very quick one, 100% of eligible deposits, and you're looking at that over either 12 or 24 months. So that's the first thing you're going to determine if it's 12 to 24 month consecutive personal bank statements, and depending on the class and the qualification that those. And then if they have going through that, then you're going to use 100% of eligible deposits as qualifying income. But you must remember 3 months of business bank statements are required to document that the borrower has a separate business account. And so if you're using personal bank statements, you need to have the 3 months of the business bank statements to document the borrower has a separate business account. So if you're combining the two of them, then they need to have at least 3 months of business bank statements. So if somebody gets started in a business, they start working off of personal and then they start making money and say, oh, I need to open a business account. And they open it up. If they just opened it, you cannot use the combination of the two. So you need to have at least 3 months of business bank statements. And if you have any additional questions on that, type them up there, and I'm sure Mindy can help us to answer some of those as well. Rental income. Rental income is acceptable. A current lease is required. The requirements on having to include the PITIA in the debt to income ratio, the DTI, is determined by the account the borrower deposits the income into. If rental income is deposited into a business account used to calculate income, then the PITIA must be included in the DTI unless evidence on the bank statements the business pays it. Also, no vacancy factor is required since an expense factor is already taken into account this, and you need 12 to 24 months of rental deposits. If the borrower has a separate account where all of the rental income gets deposited, then the PITIA must be included in the debt to income ratio unless there's evidence the mortgage payments are paid out of that specific account. And in that, a 25 vacancy factor is required. So again, there's a lot listed there. You can grab the slide deck. I'm going to actually make sure that it's up here again. So you see that link there. You can click on the link, open it up, print it off, go through this. You don't have to remember all of this now, but later on, you can access that information. So let's talk about the landlord history. So when the subject is an investment property, 2-year landlord history is required, and it must be documented by 24 months of bank statements or a third-party CPA evidencing length of the rental history. So the documentation, 24 months of bank statements used to document the income, 2-year history required. In order to use the rental income, a third-party CPA letter can be used, but it must evidence the length of the rental history. Now, if they're converting a primary residence to an investment property, this is not required. So again, you want to talk to your Finance of America account executive to be able to go through any specific scenarios that you may have if you have someone who wants to use this program and has rental income that they'd also like to use to qualify. Next, wage earner. So you have borrower that is self-employed and we're going to use their income, and you have a co-borrower who is a wage earner and they're W-2. So that is an allowable source of income for the co-borrower. You still need 2 years of income documentation. You need 30 days of pay stubs. You need 2 years of W-2s, and you need a verbal VOE. The income must be stable and it must be likely to continue for the next 3 years. So same kind of standard qualifications that we're used to. If you are using personal bank statement, salary wages are to be deducted from the deposits when calculating income, and tax transcripts are not permitted. So this is kind of one of those common sense things. If you have someone that's self-employed, everything goes into the personal bank statement, you're going to use that to qualify. But you have your W-2 wage earner, that also goes into their personal bank account. That income is going to be deducted. So it's one of those common sense things. But you can still use what they earn to qualify. So again, it's being able to offer this when you're combining the households, which is very common nowadays to have a self-employed borrower and a wage earner. So you can combine those two together. So there's a number also of what's considered quote unquote other income options. And we will cover the other income section of the full FlexX bank statement program in upcoming webinars. So you want to check also with your Finance of America AE for more guideline details. But I'm going to talk about a couple of highlights here. Tax transcripts are not permitted to document income. So when you're looking at other types of income, what you want to do is say, what are the other sources of income? And then contact your FAM account executive, and they can go through the guidelines with you to find if that's income that could also qualify. So let's talk about some of the additional guidelines. We've gone through the basics as far as what's allowed for them to use their bank statements, both personal and business. We talked about rental income, need to have that 2 years history, but they can still use that. Need to make sure that all of that income is documented. So let's begin by talking about eligible borrowers. U.S. citizen, permanent resident alien, and non-permanent resident aliens are eligible for this loan. Non-occupant co-borrower is eligible for 1 unit primary residence, 80% maximum LTV. You need a minimum FICO of 680. It is available for rate and term refinanced properties. It does require that the non-occupant to be on the title for 6 months. And cash out refinances on this with the non-occupant co-borrower are not permitted. So again, what you want to do is contact your Finance of America account executive. You have someone in a scenario may make a difference on qualifying someone. So it's important to remember this. Keep it in your pocket. Say, hey, you know what? I was on a webinar and Ginger was talking about there's a program where we could possibly use a non-occupant co-borrower for someone who's self-employed. There needs to be some planning on it. So you need to kind of look at that, especially if it's a refi, but there are some options there. And that's what I always love having, is some options available. First-time home buyers. So eligible for this program, again, great opportunity. Our millennial population, it's the highest percentage of first-time home buyers and makes up over 26% of the market today. And it's important for them to have an option because a lot of them are self-employed too. I mean, think about, there are people making millions of dollars on YouTube. How do you document that income? So this is an opportunity for them. Obviously, they need to put it into a bank account, but there are definitely some different ways that people earn money today. And this would be a great little opportunity for you to maybe look for some of those people in your area. So maybe you already know them or somebody else knows them. So having those conversations are important. The thing for qualifying is the borrower is considered a first-time home buyer if they have not had ownership interest in a property in the past 5 years with prior mortgage reporting on a credit report in good standing. They are eligible for primary residence only, one unit only, up to $1 million. They need 12 months of reserves. And the prior rental history is required for the past 12 months. So those are things that you want to look at for eligible first-time home buyers. Eligible states, purchase, rate and term, cash out refinance, all are available except in the state of Texas, where this program is only available as a purchase only. Type of transactions includes a purchase, rate and term refinance. So rate and term refinance you can use to pay off subordinate liens, must be seasoned for a minimum of 12 months. If a subordinate lien is a HELOC, they must have no draws in the past 12 months. And their incidental cashback is not to exceed their lesser of 1% or $2,000. Also, transactions that are eligible are cash out refinance. Need 6 months of seasoning, except when delayed financing is met. Property must not be listed for sale 6 months prior to the application date. So not the funding date, but the application date. And so here's the requirements as far as ownership that you're going to look at on what the value is appraised on for all refinances. So you want to look at that if you're determining for a rate and term or a cash out refinance. All refinance transactions do require continuity of obligation. Let's talk about cash out. Maximum cash out will depend on the credit class. Remember at the beginning we talked about the 3 different credit classes that we have eligible, the elite, the VIP, and the insider. So those are the qualifications you're going to look at for cash out. This is the maximum. All permit $500,000 following standard guidelines. And the elite and the VIP require one compensating factor. And so you want to look at that if you're going to go greater than the $500,000. So you have to have the one compensating factor. Trade line requirements. They have 3 options to meet trade line requirements. So again, this is one of those great opportunities for people who may not have the standard trade lines. So let's look at option number 1, which is 3 trade lines required. They need to have 1 reported for 24 months, all active in the last 12 months, and they need to have 1 minimum $2,500 high credit balance. So that's option number 1. Option number 2, which is 2 trade lines required. They need to have 1 mortgage for a minimum 12 months during the past 24 months, and it can be either open or closed. And then they need to have 1 open and active trade line. So that's option number 2, which is your 2 trade line requirements. Now let's look at option number 3. They have 4 years of credit history. So they have 8 or more trade lines. More than 1 is reported in the last 12 months, and more than 1 is a mortgage. So those are your 3 different trade line requirements. So you have different options there. And I said a couple of questions on some DEROGs. So we're going to talk about derogatory credit. So derogatory credit is another guideline that is broken down into our 3 credit classes. So our elite, our VIP, and our insider. And as you can see, the elite has longer seasoning requirements. And then your insider has shorter seasoning requirements. And the seasoning is measured from discharge, dismissal, or completion date to application date. So not funding date, but application date. So you want to look at that, especially if you're looking at bankruptcy, whether it's a 7 or a 13, that's going to be based on that time to the application date. And I know that's important because sometimes you've got some people that are like, okay, I had a Chapter 7 2 years ago that's going to, be coming up on 2 years. You need to make sure that you time that out to your application date. It is required that they have reestablished credit, and it's considered their reestablished credit is 0 times 30 in the past 24 months. The seasoning is measured from the discharge date, the dismissal, or the completion date to the application date, as I said. Multiple events, however, are not permitted. So this is one of those things that you want to look at. If they've had a few different things going on, you want to talk to your FAM account executive and make sure that they've had that reestablished credit with 0 times 30 in the past 2 years. So those are the things as far as any DROG credit that they've had. And for self-employed borrowers, those kind of things can come up, especially if, they're in a volatile business or they're just getting started or things like that. So make sure you know the guidelines for this. Also, on collections, all credit classes follow the same guidelines in regards to non-medical collections. So Elite, the VIP, and the Insider. Medical collections are separated by these different credit classes. And you want to remember, for your medical collections, if a borrower does not meet one of the requirements in the credit classes, they can be downgraded to the next credit class. So actually for your non-medical or your medical. So maybe they fall into, a VIP class, but they have some medical collections. You can downgrade them to the Insider class and be able to use that for qualifications there. Disputed accounts. So if you have a disputed account, it must be removed from the credit report unless there's documentation that supports the dispute is valid. Credit must be rescored, and any derogatory account must be considered when analyzing the borrower's overall creditworthiness. Debt to income ratio, that's listed here under your Elite. Again, the 3 different classes. Elite up to 50% DTI, VIP up to 55% DTI, Insider up to 50% DTI. And if you look at some of those compensating factors that you're going to have, if you're going below those, then you may be able to qualify if there is a compensating factor to be able to use that as well. So again, contact your Finance of America account executive to be able to know if you do have any issues on your debt to income ratio. The residual income required is based on your loan amount. And we have a residual income worksheet that is required, and it can be found on the income calculation worksheet, which is located on FAM Platinum. If you're not sure where that is, contact your Finance of America account executive and they can get you pointed in the right direction. In fact, I'll make sure and send that Kyle in a follow-up email so that they can have access to that as well, just where it's located at. You will need to complete the income sections, the monthly housing expense, and the total obligations. And when you do that, so the great thing about Worksheet, you plug it in there, the formula is already in, boop, 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 the income, the residual income will automatically be calculated. So you don't have to remember all of this, but you do have to use that income worksheet. Payment shock is also found on the same tab in the worksheet. And so all you need to enter is the current housing expense, PITIA, and the proposed will be pulled from the housing expense you just entered for your residual income. And so if you're looking at anything that is over 150%, will show a pass. It's up to underwriting to condition for any required compensating factors. If you don't meet that, a warning pop will go up. And that'll go up on different classes. So again, get into the worksheet, play around with it, contact your FAM account executive, and make sure to include all the information in there to be able to calculate the correct payment shock. Maximum finance property. So maximum is 4 finance properties. So if they have more than 4 finance properties, they are not eligible for this product. There is additional 6 months PITIA reserves that are required for each finance property, which we're not going to get into right now, but you can find that in the guidelines and contact your Finance of America account executive, and they can help you get through what those requirements are. Minimum borrower contribution. So for purchase transactions, they do require that 5% come from the borrower's own funds. And so that's the minimum. So they need to make sure they always have a minimum of 5% that needs to come from them, cannot be a gift. Let's talk about appraisals. So depending on your loan amount will determine the number of appraisals that's required. A collateral desktop analysis, a CDA, is required on all loans. So just make sure that you pay attention to that as far as the appraisal requirements. And then properties that are located in a declining market are not permitted. Compliance, non-QM and HPML are permitted. You have required forms. So you need the underwriter's ability to repay form, the ATR form. You need the initial borrower ATR certification, as well as the final borrower ATR certification. For your high-priced mortgage loans, you need the worksheet, if they're applicable, and then you need the underwriter residual income worksheet, which is what we went through just a little bit ago. So a lot of information. I don't expect you all to remember all of that because it's just virtually impossible. But the highlights you want to think about is, first of all, do you have self-employed borrowers? Rates are great right now. If you're not marketing to your existing database, this is a great time to be able to market to your database and to find out if they are self-employed. Just send out an email. Hey, if you're self-employed, I have a great product available for you. And to get in to be able to do that. Great opportunity there. Contact your partners. So your realtors, and let them know, hey, do you have anyone that's buying a home that's self-employed? I have a great program. We can use business bank statements. We can use personal bank statements. If you have someone that has rental properties, you can use that income. All kinds of options here. What this excellent program gives you is the ability to go out and to do marketing. So if you don't have anybody right now that you're saying, hey, this would be great for them, then you want to start marketing on this program and be able to get into the details. And I have a question. Do you have marketing material for this product available? I know we have some flyers made, and so I'll check with how many we have on those. And we are in the process right now of getting a slide deck approved. And so, yes, we do have those available for you to be able to go and to use out. And talk about it on social media as well. I'm tomorrow flying to Charlotte, North Carolina. I'm speaking at the Housing Wire Marketing Conference and talking about social media. And so you think about all these kind of things to be able to talk about, to post out on social media and just make a little graphic. Hey, are you a self-employed borrower? Give me a call. I have a great loan program that you may be able to qualify for using your bank statements. Self-employed borrowers have been probably the most hit by the challenges, obviously, we've had over the past several years. And so having a program like this available is fantastic. Okay, so I'm going to go on to our Q&A section, and I'm going to ask our experts here, Mindy and Kyle, to hop on. And Mindy, if you want to unmute yourself, I'm going to, and Kyle, this, so of course, rates. The first question is, Pauline, I'm going to answer your questions. What rates are we looking at? So this is on page number 7 of the rate sheet. So remember, lucky number 7. And if you're pricing this out in optimal blue, you want to make sure and say you have a self-employed borrower. So you can see this as an option. This program is only available for brokers, so only broker wholesale. So rate sheet, page number 7, optimal blue, make sure you select wholesale, self-employed borrower. And then question, Kyle, for you, are these ARM products or fixed products?
They are a little bit of both. So on the Elite and the VIP, we have a 30-year fixed, and we have a 5, 7, and 10-1 ARM that also come in interest-only options. And on the insider, we have the 30-year fix and the 5, 7, and 10-year arm, but no interest-only option for the insider. So if you go to our product guidelines, the very first page will show you all the different products that are available in each credit category class with their term and all that, their program code and all that fun stuff.
Excellent. Thank you. Quick question, and Mindy, I'm going to throw this over to you. Is there a reason why it's not available for a Texas refi?
All of our jumbo products right now are Texas purchases.
Okay, perfect.
Yes, and I'm going to add to that. So Texas refinance laws have a little bit of complexities. They're typically done under the special like A6, A4 refinance programs. And so I think just for ease of use when we're creating these new programs, they are purchase only in the state of Texas.
Yeah, and Texas is one of those, if you're in Texas, you know this, that refinance, especially cash out, has been a challenge. I know there's some recent legislation that has changed some things for you there, but right now it's purchase. So, and Kyle, talking about the different arms and interest only and all of that, remember when you're looking at that, that you have to look at the different class qualifications as well. Okay, so question, Mindy, what is the definition of an eligible deposit?
So in our guidelines, we list ineligible deposits. Ineligible deposits are cash advances from credit cards, income sources already taken into account on the bank statement, tax refunds, gift funds, product returns and credits, and line of credit deposits or business financing. So they are ineligible.
Okay, and that's kind of a common sense thing, guys, because it's really not considered income, right? Okay, so next question, how they treat NSFs on bank statements. And again, we're going to get into a lot of these. Bendy did a fantastic job, and we have a lot more training that's available on this. But we wanted to make sure to give you the overview first. So we are going to have webinars that are going to go into some of those NSFs as well. But if you can do just kind of a maybe 30,000 foot level, Mindy, for that on how they're treated.
So on our product, NSFs are treated a little bit different. We don't look at the individual NSF. We look at events. So we define an event as more than one transaction NSF transaction that's occurring within 5 business days. So based on the events, we have our guidelines broken down by the credit class. So your elite borrower, we don't permit any NSFs. For your VIP, we allow one event in each 12 months. So if you're looking at a 12-month bank statement program, you can have one event. If you're looking at a 24-month bank statement program for your income, you can have one event in each of the 12 months. And our insider allows 2 events in each of the 12 months. So remember, an event is more than one NSF occurring within 5 days.
So again, this is one of those that you're gonna go through the income calculation. You're gonna look at what kind of bank statements they have. As you go through those bank statements, you're going to go through the bank statements probably before you're really able to consider what class they're in. Is that right?
So we do have a quick reference sheet. So it's very helpful to look at that first to kind of take a high-level overview as to what credit class your borrower is in. You do have to list your credit class on your income calculation worksheet based on validations that we have built into the worksheet. And NSFs are in the worksheet as well. So it'll help you determine if you qualify or not.
Great. So really grabbing that worksheet is one of the first things to do, is to, find out what kind of bank statements they have, personal or business, how many businesses they own, and then gather those bank statements up and then determine through the worksheet what you're looking at and calculating and going through that. So, and just a quick question for you too, Mindy. We've talked about the 12 months and the 24 months for bank statements. And I know this is a new program for you. So just what do you see as the most common? What should people be looking at?
So you can use what either 12 months or 24 months. Depending on the type of income, you might be cyclical and you might need 24 months to document the income. If your DTI is greater than 45, we will require 24 months. But there's no difference in like the product when selecting the product or pricing if it's 12 months or 24 months.
So really it gets down to an income qualification. So if you have somebody that they're going to qualify, have more income to qualify over 24 months, maybe they're newer business or, had some compensating factors, then you want to look at that. Don't just limit it to the 12 months. Maybe going into the 24 months might be able to give you more income. We have a question as far as investment properties not allowed. This is owner occupied only.
Investment properties are permitted in the VIP credit class.
Okay, so only in the VIP credit class are investment properties permitted. And question, what is required for a verbal VOE since they are self-employed?
So it would be your normal VOE that's required for all self-employed borrowers. It would be your standard verification of employment.
Okay.
That we look at your third-party business license, CPA.
So letter from a CPA, business license.
Business license.
Okay. So really it's not a verbal. It's just a verification of employment. So think of it as a verification of being in business is really kind of what it is. It's your standard, what you already use already right now. So nothing different there, right?
Right.
Okay.
Yep.
Perfect. And so I'm seeing a couple of you are putting in scenarios, and as much as I would love to be able to go through them, for the sake of time, I'm not able to. So what I'd recommend for those of you who have certain scenarios to reach out to your Finance of America account executive, and you can answer that. I think we do have one question, Kyle, that you said you were going to go ahead and address, and I'll let you go ahead and handle that if you'd like to do that.
Wait, I'm so sorry. Which question was that one?
Oh, I thought you had typed in that you had a question you were going to answer about the not-for-profit.
Oh, no, I'm sorry. So that one, the nonprofit one, the income, we'd want to reach out to the account exec and kind of run that scenario.
Perfect. Yeah. If you have a particular scenario, the best thing you can do is contact your Finance of America account executive, and that's really the next thing, is to be able to, first of all, think about who you may have, who may be someone that, hey, this is great for them right now. And so give them a call, say, you know what, found out about a great new program, this is available. And so want to talk to you about a couple of things. Think of your questions. The first thing is, how long have you been self-employed? How many businesses do you own? And how do you do your banking? Do you have a personal bank account? Do you have a business bank account? What does that look like? So I would start with those questions. If you don't have anyone that comes to mind right away, I'll make sure and send out in my follow-up email tomorrow that I'm sending to you with the recording and the slide deck. I'll send the flyer, as I know we have a flyer available. And I would say pull something from those bullet points and put something out onto social media saying, hey, are you a business owner? Contact me today. I have a great bank statement loan program you may qualify for. Always remember, you may qualify. Don't say you do qualify. And so those kind of things. And then your database. You have an incredible wealth of contacts. And if you are not consistently marketing to your database, you should consider starting it, number one, and this would be a great program to be able to do that. In preparing for this session that I'm doing tomorrow for Housing Wire, I pulled some information as far as Ellie Mae just put a survey out, and they surveyed renters. And all renters want to know, they want education. They want education on products, and they want education on down payments, on how much required. And what's interesting is over 50% of first-time homebuyers think that they need 20% down to get a mortgage. Millennials do not understand how much they actually need and that loan programs are available. So it's our job to really get the information out and to start educating. And this is one of those great opportunities because with this program, they can be self-employed. They only need 5% of their own funds. Obviously, there's other qualifications there, but those are the kind of things to think about. But if you do have additional questions, please contact your Finance of America account executive. Mindy, Kyle, thank you so much for being on the call. For all of you that have been on the call, thank you so much. Get registered for our webinar that is coming up on June 20th. You can find out those events at famuevents.com. Look for my email tomorrow with all the documentation. And everybody stay cool, and we'll see you on the next webinar.